We are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Property of the Week. I am your host, Pablo Gonzalez. With me, as always, the man we call GC, because he's making a great comeback today, because of his genius concepts, because he generates cash flows. He's a great co-host, and because his name is Gregg Cohen. Welcome back, GC.
Hello, everyone. Thank you so much for being here. I can't wait to get started on the Property of the Week.
Property of the Week, Veterans Day Special Edition. Thank you all for your service. And we like to say around here that if you want to learn about rental income property investing, you're in the right place. If you want to find out about best-in-class property management for rental property investors, you are in the right place. If you want an edge on the Jacksonville real estate market because you're a real estate professional, you want an edge, you're in the right place. Next place to go for the tailored advice is chat with JWB.com. Get yourself a free consultation there. It's a very value add thing. GC, I think we got something. A couple of things. Checking in the chat. Oh, the roll call. Bro, what is this? My first rodeo?
Dude, where have you been? Like, I came back so I could say hi to everybody in the roll call, or at least let you run through it.
I'm so flustered. You ready, bro?
Let's go.
All right. John Hannon, good afternoon. All. Drew Barnhill, good afternoon. Dean Curry from Columbus, Ohio. Good afternoon. Leo F. from California. Good morning, Leo. Lee Bishop, the MVP of the community. Great afternoon, everybody. Jennifer Filson, the fairy godmother of the community, sharing the love. Happy Veterans Day, JWB family. Right back at you, sister. Who else we got? We got Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
She says, hello, folks. Happy Veterans Day. Who else we got? Lee Bishop's got a grandson, said his father is protecting America. My grandson said his father is protecting America. Love it. Lydia Filson, the mother of the godmother of the mother of the fairy godmother of the Not Your Average Investor Show community. She's in the house. She says, hi, gang. Who else we got in the chat? Talk to me, folks. Let me call your name out on the roll call. Anthony Ditta's in the house. Hi, gents. Been away for a bit. Hope you're doing well. Anthony, we're happy you're back. Aurora Carp is back as well. Good morning, everybody. Who else we got? Nadeem is in the house. Good morning. Good afternoon, everyone. Happy Veterans Day. Thank you for your service, he says. And I'm going to scroll. Ken Moline, star of the family, the patriarch of the Moline clan, which is the first family of the Not Your Average Investor Show. We established that last week as well. All right. I think that's it for right now. But we have breaking news. We have this is not the breaking news. As you may or may not know, if you're part of this community, we have an in-person meetup of the Not Your Average Investor Show family coming up on December 3rd here in Jacksonville. It's in the after. Greg, why don't you? The breaking news is that we're getting a sweet tour of downtown on scooters. Greg, tell them about it.
Absolutely. So the local chapter here, Jacksonville, of the Not Your Average Investor Group, is meeting December 3rd. And normally what we do is get together and have some drinks and some appetizers, and we talk about investing. There's not too much to it. We just love that it's informal, and we'll usually have our folks come on out, and really it's just a wonderful extension of this community. And we've done this, I don't know, maybe 4 or 5 times in different parts of the country, and everybody has really, if you're within maybe a 45-minute drive, you've come, and it's been a really wonderful thing, and everybody's had a blast. So we've got one of those coming up Friday, December 3rd, and we would love to extend an invite to all of you who are here. We do have folks that are traveling from far distances to fly in to be here, and we're super appreciative of their time and their efforts and their contributions to the community. And so if you're local, you really don't have an excuse now that you got people flying in from miles and miles away. So we would love to have you. This one's going to be super special. Big shout out to Jen Filson, our fairy godmother of the Not Your Average Investor community here. She has been working to set this event up, and she has really done a wonderful job. What we actually are doing this event, this Friday, December 3rd, when we do this, we have this special tour lined up. And we're going to, all the things that we talk about happening in downtown Jacksonville, you guys get to hear about it and hear from other leaders here locally. You get to kind of see what's going on, but there's nothing like seeing it from ground zero, nothing like seeing it and walking Jacksonville's downtown skyline, the river, and actually seeing what is going on. So we are lucky enough to have a personalized tour just for our group here. And it's going to be done by Alan DeVault, who is the CEO of Build Up Downtown, which is a local advocacy group. JWB is a huge supporter of Build Up Downtown, and Alan is an incredible opportunity to spend some time with Alan to be able to show us all these things that are happening, actually walk downtown. We're going to have a blast doing that on Friday afternoon. So don't know exactly when we're going to start that tour. We're still finalizing the details, and Jen is here in the chat. And if you are interested and you'd like to be a part of it, just send a note to Jen here in the chat. Or Jen, if you wouldn't mind, let us know your email address or the best way for people to get in touch with you, if people are listening on the podcast. And then we can make sure that, we can accommodate you to be a part of this tour. And then, of course, to be a part of the fun dinner and drinks that we have going on a little bit later in the afternoon there. So super excited. Can't wait to see all of you there.
GC, I got breaking news for you, buddy. We're not just doing dinner and drinks at 4:00. We are celebrating Ken and Carolyn's 60th wedding anniversary on that meetup as well. 60.
We are?
Yeah.
Oh my goodness. I did not even know. See, it just gets better and better and better. Congratulations. 60 years, Ken and Carolyn. That's amazing.
Yeah, man. Listen, I'm not kidding that I'm like holding back tears, right? Because like I love doing this with you, man, right? But you've known all along that the whole reason we're doing this is because what I really want to do is create a community of awesome people. And the fact that this is really happening, the fact that it's, happened multiple times, that we're doing the second iteration here, the fact that we're like celebrating a 60th wedding anniversary, that there is, all this other stuff. It's really special, man. Like it's really, really cool.
I'm with you, buddy. When we went down this path, I didn't really know if this would be possible, if our message and our community would really resonate. And to think that we are going to be joined by an incredible group of friends and investors, and to think that on their 60th wedding anniversary, they're setting aside some time to spend with us is amazing. I just celebrated my 10th wedding anniversary last week, and I know how special that was for my wife and I. And to be able to spend some of that time in our community means a lot to me personally as well. So thank you so much, Ken and Carolyn.
Yeah. Really, really cool. All right. So Jen is asking me to sing "We Are Family" on this, and I'm obliged to do it. So what is it? We are family.
Dun, 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 dun.
Not your average investors and me. All right. So we got it. We got a question from Dean, who's coming to town. He's saying he's staying in the downtown South Bank area. Is that a walkable area?
It's relatively, come back in 5 years, it'll be a lot more walkable. It's not that walkable right now, but you know what? You're just gonna go right over the river, and you're gonna be a part of the tour there in the North Bank, which is where, we're gonna be walking through downtown. So you're not far from being walkable, but it's not exactly walkable.
Yeah. Okay, cool. So I'm just going to say this out loud for those like our friend that's listening in the podcast right now in the future. Jen Filzen, to get in contact with her to come to the meetup is jenniferfilzen.com. That's JENNIE. No, it's JENNIFER FILZEN @gmail.com. Or you can call or text her to 408-833-9868. The other thing I'm going to prompt is go to JWBinventory.com right now, download the property of the week sheet so that you can follow along at home. So while we are tinkering with this, Bill Shields in the house. Buenas tardes, familia. Buenas tardes, Bill Shields. So go to JWBinventory.com. Joanna is, if you're here on the call, Joanna just put it into the chat where you can just click one time, download the sheet so you can have it as well. If you're listening on the podcast, when are you going to join us live on the show? Just saying. I'm just saying. If you're on Facebook right now, when are you going to join us live on the show? The party is in the chat during this show. So come on down. All right. As we, Bill Shields got here in time to sing the excellent singing. Bill Shields, I'm going to sing that in Spanish for you on December 3rd. So, all right. We are now going to the property of the week.
Week.
I am whisking us away to the magical area of 4494 Twin Hills Way, Jacksonville, Florida, 32210. It is a $280,000 new construction home, 4-bedroom, 2-bathroom. It's got a 2-car parking garage. It's going to be leased out at $1,675 per month. It's got a conventional financing total estimated cash flow, I'm messing that one up, of $136 per month. And it's got an estimated conventional financing total ROI of 7.27%. But we have a new way of starting these POT dubs out here. And it's this. Hey, GC, what do you like about this house?
Never thought you'd ask. Thank you for asking. There's a lot of things I love about this house. And as you guys know, I love this asset class more than I love any individual property. I love this asset class for a number of reasons, right? I think about where could I best put my money as an investor today? And there just aren't a lot of asset classes out there that give you consistency, that give you a high floor, that give you upside, that give you monthly recurring revenue, that allows you to access debt and still have it pay for itself. And, and that's what I love about our asset class. But I always try to go into each one of these properties of the week and point out something you may not know about this property or this neighborhood or something that, quite frankly, hopefully interests you and you may not know, but it's impactful for why this is such a great investment. What I've chosen here for this property here at 4494 Twin Hills Way, for those who are watching live here, you can see this is a brand new construction home. I don't know if some of you know about brand new construction for JWB, but in brand new construction homes for JWB, we actually go above and beyond when it comes to some of the materials we put in the house. And specifically, we put granite countertops in the kitchen area for a brand new construction home with JWB. We started to do this, a number of years ago. It hasn't always been this way. You don't need granite countertops to rent a brand new construction home. But what it does is it gives you a little bit of a bump to rent. And what it really does is it decreases your maintenance costs long-term because granite holds up much more than the other alternatives out there. And this is an example of JWB spending the additional money, right? I don't know what it costs to put granite in versus what we would otherwise put in there, but I know it's something. And we made that decision to go ahead and spend that money so that long-term our clients are going to have a better revenue stream from the rent and also have reduced expenses. So if there's one thing that stands out about this house that you might not have with other houses is granite countertops and what it will do for you for increasing revenue and decreasing expenses. And this is the way it currently is for all brand new construction homes within JWB.
There you go. We got Rick in the chat is asking, where does he go to find out about private lending on new constructions? We know that Jamie Crawford is the queen of private lending, and we had a recent episode with her. Joanna, if you can find that episode, I think it was a week or two ago. It's probably one of the latest ones on private lending. Mm-hmm. So Rick, you can check that out. But easiest way to get on her calendar, chatwithjwb.com.
That would be one way. If you want her direct email address, it's very easy. It's jc@jwbcompanies.com, or you can call the office 904-677-6777 and ask for Jamie. Or you can go to chatwithjwb.com and we'll make sure that we get you on her calendar as well.
There you go. It is a well-oiled machine over there at JWB. So I have never called JWB and talk to somebody that wasn't like, oh yeah, I know exactly what you need to know, who to give you to. They over communicate over there. So you will, however you collide in there, Rick, you're gonna be well taken care of. I promise you that. So granite countertops, GC, we've talked about that maybe one other time on the show.
Yeah.
So what drives that decision as an investor and, like how you guys are doing how you guys are renovating? What drives that decision?
It is us looking at something that we can do with a relatively low additional cost to JWB that should have significant impact in increasing ROI for our clients long-term, right? We know that, and I don't exactly know what the cost is, as I mentioned, of the granite, but for us, it is within reason, right? We're already building this house. We're spending $130,000 to build this house. It's a slightly additional cost there. And if we do that, we know that over time that you're going to have less expenses and you're going to get a little bit of a bump in rent. So for us, we look at that and we say, well, we're going to weigh the pros and cons here, right? We can't just do everything we want to do to decrease expenses long-term, or else we won't have a business here. But if there's an opportunity for us to look at this and say, how can we separate our product from the other products that are in the marketplace? How can we separate ourselves as a provider from the other providers out there? Is this the right place to do it? And we analyzed a number of years ago that this was the right step to take at that moment to do that. And so it's been that way ever since. But this truly is a cost that JWB bears no matter what, your cost is not going to be going up because we put it increased, because we put the granite countertops in there, but you get the benefit of all of it. And that's really how we think about things, right? We want this to be a win for our residents. If it's a win for your residents, it's going to be a win for you as as an owner of the rental properties, and long-term JWB is going to win if we do that over and over again, because you're going to come back and buy more houses from us. So it's really just, an example of that.
Makes sense. That's what, it's funny, right? Because I'm in strategic planning right now. And what we're really trying to nail down is this idea that how do we use our own service the best that anybody can use our own service?
Mm-hmm.
And I see that very much a parallel, right? It's something I've learned from you, because everything from you at JWB is driven by the fact that y'all are rental property investors and you are perfecting it for yourself so you can do it for others. It's this like cumulative advantage of always like being one step ahead of whatever is going to come, and knowing what your, having the client's perspective in mind, because you're your own client, right?
Mm-hmm.
So like kind of, this is Granite Countertops, but how you just answered that question is like how you answer every question. Whenever I ask you of just like, why did you make that decision? It's always because your incentives are aligned with your clientele.
Yeah. I mean, that is the baseline for us. Now, I do want to point out though, that guys, like I mentioned, this is not always the way it has been done, right? Like where we have been in the past for rental property investing is that we had lower purchase prices back in the day, right? Lower purchase prices and our rents were still high. So that meant that we had higher returns on investment for our clients back in the day, right? That meant that we were able to pay more, we didn't pay as much for properties when we acquired the land or the property back in the day, but things are changing now. And so I have told everybody on this show for a long time that right now is the best time, in my opinion, to be buying rental properties. If I had a goal to accomplish a certain amount of passive income, and I maybe was thinking that I needed, I talked to JWB and I saw that I was going to need to have 5 rental properties to accomplish that goal, because you went to chatwithjwb.com and you had that conversation and you said, well, I've got money in the stock market over here. Maybe it'll take me 5 years to build out that plan to get to 5 properties with JWB. What I would highly advocate is to think about changing the timing, right? Taking some of that money that you already have in other investments and putting it more into rental property investing right now, because interest rates are so low, because cash flows are still positive here, and because we expect higher than normal home price appreciation in the short run, right? And when you have that, that creates this incredible opportunity to acquire now. I really think that. And the way that this relates to Granite Countertops is that this isn't a foregone conclusion that JWB will always do this, right? We are still going to be able to have best-in-class product, best-in-class service going forward, even if we don't have granite countertops in the kitchens. Because what you're going to see, and every provider is dealing with this right now, and JWB is dealing with this right now, profit margins are getting cut because acquisition costs are so high to acquire inventory, and because building costs are so high right now, and probably will be for a while now. So when that happens, if you just think macro wise, you're not always going to be able to offer all of those, kind of call it maybe a fringe amenity that isn't critical to the investment, right? So now I don't have any plans right now to scale that back at this moment, but I do know over time, there is going to be pressure, not just within JWB, but across the entire investing landscape, and much more pressure in other providers in other markets, to where they're just not going to be able to have inventory unless they make some of those decisions to not put granite countertop in your kitchens. And, so that's a real thing. So like I said, I don't have any, we are not changing anything at the moment, but I do know where things are going. I know that home prices most likely are going up in future years. And I know that interest rates are most likely going up in future years, and that's going to compress cash flows. That's going to make this profit margin of this entire industry less. And so those are some of the things that you guys are going to see not be there in future years. And you usually typically don't even see it with other providers now. You don't usually see granite there. So another reason why I do believe this is the best time to be investing, building out your rental property portfolios, because now you get to take advantage of amenities like this that you might not always have going forward.
There you go. There you go. All right. So we've been beating that drum for a while, right? Like prices are inevitably going up. Interest rates can't go down any further. This is a unique moment to get in, which really all it means is that whatever you were going to set aside in your portfolio for rental properties, try to speed that up. And like, for example, me, right? Like I am right now over investing in rental properties versus what I want it to be a percentage of my whole portfolio, because I think it's the right time to get in. And I'm going to worry about building the rest of it, diversified it once I get to my 3 properties right now as quickly as possible, because I see this like idea that I'm in this window of time that Rich Ritchie described on the show that creates generational wealth and being able to like look into the future. I know I'm not the only one, because Drew Barnhill in the chat is saying, yes, my 3-year plan is quickly becoming a 1-year plan. And that's kind of the way to look at it, right? That's what the sharps are doing. Mm-hmm. Right. Okay. So we got a couple of questions already in the Q&A. This is a question driven show. So you start bringing questions, we'll start answering. And if you don't, then we'll continue talking about this property or however we see fit. So Lee Bishop, MVP of the Not Your Average Investor Show community, he puts here in the Q&A, it looks like the ROI is better for non-recourse lending versus the conventional loans. Is that because the rate is better for the non-recourse lending now versus a couple of years ago?
You know what? Let's go ahead and go to the non-recourse tab and let's figure it out together.
All right. Why don't we do that?
There we go.
So down here's the tab. If you download this property from JWB Inventory or the link that Joanna puts in the chat, you can go straight here and tinker around with it. Hey, we got Eileen Mateos in here saying she just bought 2 from JWB and signed my agreements today.
Congratulations, Eileen. Amazing. Yeah, that's great. That's really wonderful.
Yeah. And Eileen, you only told that to me and GC right now because you're under host and panelists where you chat. If you want everybody to see what you write, you got to put everybody. But for now, I'm just going to say, because we're pumped to celebrate this, I'm looking forward to end this year with a great investment. Right on, Eileen. I love that.
Super excited. Eileen, I'd love to hear how you found out about us as well. If you wouldn't mind throwing that in the chat, always super curious. Thanks so much for your trust with us.
Yeah, Eileen, I would love to know how you found out about us as well. So we went to the analysis non-recourse financing tab. GC is going to teach us how to calculate what Lee Bishop said. Before we get into that, GC, he said the ROI is better for non-recourse financing. Is that accurate? Is it the ROI or is it the cash flow?
Well, it depends, right? So with non-recourse financing, that's a function of your down payment and your interest rate. So with the interest rate has actually gone way down. The down payment, this is the reason why I was going to see what's on our tab. We still reflect 50% down for your down payment for non-recourse. We do have a partner that is willing to go a little bit less in the down payment percentage, all the way down to 40%. But in our evaluations, we always put the most conservative factor in there. So to answer your question, if your down payment goes down to 40%, then your return on your investment will go up because you have less of your own money in the deal. What has changed over the last, maybe about 2 months ago, we unveiled that we had better non-recourse terms for our partner. Prior to 2 months ago, our interest rate was a lot higher. It was 7.75%. And right now, as you can kind of see here, it's 6.75%. So long story short, when you drop your interest rate, even if you keep your down payment the same, that is going to increase your return on investment. If you drop your interest rate, which we have, from 7.75% down to 6.75%, and you also decrease your down payment percentage, then your return on investment is going to go up even more. And so on our evaluations, we're only sort of showing half of the real potential opportunity out there to increase your returns when it comes to non-recourse financing.
Hey, Greg, so when I'm messing with this sheet, when I drop the down payment, the ROI actually goes down.
Yeah. So what we'll talk about here is, so this is the difference between only looking at cash flow and then also looking at your other profit centers. So the biggest boost to your return on investment in an appreciating market will come from your home price appreciation, which is one of your 5 profit centers. So the way that we've positioned ourselves to look at this right now, we're only looking at the cash flows. If you put less money down, you have a higher mortgage balance, which means that your mortgage payment every single month is actually higher. So if you put less money down, your cash flow will actually be lower. But when you look at all 5 profit centers, which we'll probably do here very shortly, you'll see that you'll actually get more of a bump, more of a return on investment from home price appreciation because you only put 40% down rather than 50% down. So we just have to be looking at all 5 profit centers for you to see exactly how 40% down can help you.
Got it. Okay. So we're back to the original sheet here. We got Bill Oxley. He's saying granite throughout or just the kitchen. I think you just answered that a little while ago. It's in the kitchen, right? In the kitchen
Just
only.
in the kitchens.
But I'm just going to celebrate Bill Oxley. He's watched on Facebook multiple times. He's in the group. This is only his second time live on the show. So welcome
awesome.
to the inner circle, sir.
Bill is one of the most active contributors on Facebook in our Facebook group, has been there, I think, since day one, is a huge proponent of the group and the show and JWB, and always has a positive thing to say. So Bill, it is so nice to have you in the show here.
Good to have you on the show, Bill. Joanna, why don't you share with everybody the Facebook group link if you're not in the Facebook group and hanging out with us throughout the week, like Bill and like so many of our other community members. I invite you to join us. You can find it at jwbfacebookgroup.com, or Joanna's going to drop the link in the chat here for you to go to. We got over 3,000 investors just like you, trying to do the best they can for their retirement plans and their wealth creation and pass it off to generations. So it's a great place to make some friends. All right. Leslie Wilson from Denver. She's got a question. Does JWB educate the tenants on how to take care of granite? It needs to be sealed every year. I leave my tenants some special granite cleaner and polish in my Denver rental houses that have granite countertops.
You know, I know we spend a lot of time training and molding and educating our residents on how to take care of the homes. I'm not 100% certain exactly what we do to train our residents on taking care of granite, but I'm sure it's a part of the overall conversation. I wish we had asked that question for Kate Taylor, who was just on the show on Tuesday. Kate did an amazing job for those of you who were on the show on Tuesday. Kate is a supervisor on our property management team and is incredible when it comes to management of the property management business, and also making this a wonderful experience for residents that they want to come back and stay with us and stay with you as a resident for many, many years. So, you know, I don't know exactly that we go to that degree on how to take care of the granite, but, you know, I know it's a part of the overall education process of how to take care of the home.
Love it. All right. Now we are back to the sheet because we don't have any questions in queue. So GC, talk me through what we usually talk through here. What is this estimated conventional financing total monthly cash flow of $136 represent if I'm looking at this thing as an investor?
You know, I love this $136, not because of the dollar figure here, but in reality, what we're talking about is you have an opportunity to invest in an asset that pays you money every single month. And there just aren't that many assets out there that give you monthly recurring revenue that also give you the opportunity for decent return on investment, right? You know, like for example, you can invest your money in a CD and you don't even get monthly recurring revenue there, but at least it's kind of like recurring revenue, or at least at the end of the year or 3 months or 6 months, however long your CD is, but your CD rates are ridiculously low, right? I would imagine nobody who's watching this right now is probably investing in CDs right now because you guys are not your average investors, right? You're looking for something a little bit better than what a bank certificate of deposit can get you. But just when you think about bonds, right? Bonds is another asset class that people go to because it's conservative. You don't typically get monthly recurring revenue. You typically get it maybe every 6 months for a bond. But if you do that, what are bonds returning right now? Like 1%, maybe 2% if it's a corporate bond. I mean, the returns on investment there are so low. So you typically have to decide between an element of recurring monthly revenue or quarterly or semi-annual revenue, or potential return on investment. The reason that I love rental property investing starts with this $136 number. This is that monthly recurring revenue stream that's coming to you. And that's number one, right? I want to invest in assets that are conservative and that pay for themselves every single month. So with this asset, right, you do have some expenses every single month, but you also have this beautiful thing called rental income coming in. And enough rental income comes in, not just to take care of the expenses every single month, but it leaves you some, right? You have a net rental income, positive cash flow that comes to you. And that is just so rare in today's investing world. But it's so critical. The reason why I think it's critical is because I have lived through the Great Recession. I owned about 40 rental properties in 2007 as a 23-year-old kid who didn't really have much experience, didn't have much income or wealth at that point, and had it all out on the line for these 40 rental properties. And I can tell you that the reason I can sit here with you today and talk about how I've grown my portfolio to over 300 properties is because those properties produced positive cash flow, just like this property produces positive cash flow. It's risk mitigation. And when you invest in assets that pay for themselves, you then can use them and stack them on each other, meaning it becomes scalable. You can now invest in 1, 3, 5, 10, and you don't have to go into your bank account every single month to pay for them. They pay for themselves. So that's the first step of successful rental property investing, in my opinion, which is investing in assets that pay for themselves and give you a little bit left over afterwards. And that's what this $136 is. It's scalability, it's risk mitigation. It's a beautiful thing.
All right. You talked there for a while. I'm going to do a little bullet points there. The idea that you have positive cash flow in this asset class is the ticket to the game. This is the on base hit that can get you home at some point, right? Like you got to get on base at the very least, is the way that Brandon Thompson likes to put it. Mm-hmm. And the reason why is because of what you said. If you are dipping into your own accounts every single month after month, then it doesn't become very, very scalable, right? Like, because if you're dipping a little bit here, dipping a little bit there, how many can you really acquire, right? So that's part of it. And then on top of that is it's the typical monthly experience. Typically every month, if you are financing this thing at 25% down payment, you're going to get $136 in your bank account. And eventually, when all that stuff gets paid off, it becomes $1,139 at least in your bank account once you pay down the debt, right? And that is how you estimate the final retirement plan. It's like, when are you gonna need this cash flow? You know, like how much will it be paid down? Boom. Is it 136? No, it's 1,000 plus, right? That's another thing that you taught me recently that I think is pretty interesting to talk about.
It's critical. Absolutely.
All right. Eileen told us how she got here. I'm just going to read this out because I like it. Eileen is a full-time frontliner healthcare worker in California with a high cost of living, and it's almost impossible for her to buy rental properties. So she decided to invest in the Florida market, which is booming and landlord friendly. And she came in through Fortune Builders. She's a mastery student. So great partner of yours.
So amazing. Thank you for sharing that story. I'm sure many folks who are on the show right now in the audience can relate, whether, well, first of all, I want to say thank you so much for being a frontline worker in the healthcare fields. We have absolutely just so needed you over the last, well, forever, and especially over the last couple of years. Thank you so much for your sacrifice as well. But there's a lot of folks, right, that are living in high-priced markets. It may be California, maybe New York, maybe Virginia, but there are high-priced markets out there. And you love the idea of investing in rental properties, probably for something similar about my diatribe right there why I love rental property investing, but it's not local to you. Like the local thing doesn't work because you can't get positive cash flow locally. So you can invest, you have to do your due diligence to find a team. And I'm sure being on the show is a part of that process for you. So thank you so much for being here. But you do your due diligence, you find a partner that you're comfortable with in a market where the numbers work. And now this can be that other part of your financial portfolio that may not have been possible before. So thanks so much for sharing that story. I think it's very, very common and uncommon at the same time, meaning that you are doing a great thing by going out and finding a better way that most people don't.
There you go. I got another thing I got to call out here in the chat because it tickles me. Bill Oxley writes, GC and Pablo, I saw y'all's TV commercial at an earlier time slot on Tuesday. I had seen it a couple times late night around 11:30. Well, Tuesday, I saw you at 7:30 time slot, like a boss. So funny story there, Bill. So Greg and I are in this, like, we play spike ball on Sundays. We talk about it often on the show. And we got this like group of friends that we have like a WhatsApp chat going. And I think it was the same exact Tuesday night time slot. our buddy Rich Ritchie, who we just mentioned on the call a little while earlier, he sent us a picture of us on the screen saying, I'm out to date with my wife and I see you guys on TV.
It's amazing, man. You know, we've been running these commercials, and the way this relates to everybody is we do TV commercials to acquire undervalued properties, and we buy land and we buy properties, and then we of course renovate or build the homes. They become properties of the week eventually. And so this
week.
The TV commercials are a very front end part of this whole process. But you know, we had the opportunity to do it, and I was like, who else am I going to call and be on the TV commercials with me other than Pablo? So we went and put that together. And man, I'll tell you, like, just even this week, there have been so many people, you know, Bill, thank you for saying that, right? Rich was texting us. Like, I walked upstairs today and they're like, man, these TV commercials, they're just like all over the place. And they're making jokes about like how I can't fit my head through the door frame now because I'm getting a big head because we're on TV and all this good stuff. So, you know, it seems to be working apparently this week, which is really fun.
Dude, I watch like no television, so I have no idea. But everybody that I'm running into in Jacksonville these days is like, I saw you on TV. I'm like, how do you not text me every time you see me on TV, bro? Like I should get a text every time I'm seen on TV by somebody I know. Somebody should text me. So anyways, but it's happening these days. I think it's working. All right, man. Let's get back into some more serious stuff. Eileen's got a question in the chat here. Eileen, I know that you're new to the show, so I asked that you put the questions in the Q&A. I'm going to read this one because it's here in front of me, but like it's easy for me to lose it in the chat, but I see it right here in front of me right now. She asks, I wanted to ask the JWB's recommendations on how to leverage existing IRA accounts towards paying the down payment for your rentals. There was a buzz going around about SDIRA going away in 2022, and to protect investors from UBIT taxes to look into EQRP. I don't know any of these acronyms, so I appreciate you explaining this first. And can you look into this, please, is what she's saying.
Yes. First of all, I can give you some really good pointers here. I would highly encourage you to speak with your CPA about this as well, because that's really critical, right? Some of these things are confusing, and one little point that might not be 100% pertinent to your situation might change what the right thing to do is. But let's just start big picture. So what Eileen is asking about is how do we get capital within our retirement accounts to be able to leverage and buy more properties in our retirement accounts. And so, and then she's also asking about some of the tax law changes that are coming, and we'll kind of talk about that a little bit. The first thing is this non-recourse financing. So Eileen, I'm not sure if you're familiar with this, but you know, non-recourse financing is a really tricky term that many people don't understand. When you hear non-recourse financing, think about that meaning financing that you can use within your retirement account to buy rental properties. And so what's happening here is the bank is basically making a loan to your retirement account, whether that's an IRA or a solo 401k or a 403b. A lender out there will make a loan specific to your IRA. You can't just go to any regular bank out there to get a loan for your retirement account. They just won't do it because your IRA or your 403b or your 401k doesn't have a social security number. And so they won't do it because it will require a special loan, which is called a non-recourse loan. So this non-recourse loan, Eileen, is something that I would absolutely recommend you talk to your portfolio manager of JWB and talk about the options that we have. You know, and as I mentioned here, it's 50% down on our property valuations, but there are circumstances where our partner has allowed to put 40% down, and that would require less capital for you to be able to maximize the number of properties in your rental property portfolio. So that's a really good thing. May have a solution right out of the box for you there. Now, one other thing that you mentioned there is something that is really going around right now. There is a lot of buzz about the infrastructure bill that the government is putting forward, or Biden is putting forward, and what requirements that would need from a tax law perspective to change in order to be able to fund that infrastructure bill. Now, this is way early on in the process, right? It's a bill right now. It would have to go through the channels and become a law, and then it would need to be enacted and all this good stuff. So this is way early on, but it's good to pay attention, so much so that we actually are going to have JWB's CPA, the person we trust the most to handle our taxes, our accounting, our strategist when it comes to our entire tax strategy here. His name is Brian Reyes. Brian is actually going to be on the show on can't remember, Pablo. Is it next week?
It is the next show.
Perfect. Eileen, you just gave us a perfect segue there.
I know.
Brian is going to be talking about these exact questions as far as, are you allowed to invest in rental properties even if these tax law changes occur? Are you allowed to do this? What are you not allowed to do? Are you allowed to invest in private placement funds? What could change? What couldn't change? All of these good questions. We're gonna dive into that next Tuesday. So I hope everybody will join us. But I'll give you a little bit of what I have come to understand is that specifically for investing in rental properties, even when the infrastructure law bill was proposed, and with the changes they put into that infrastructure bill, did not change the availability for people to buy rental properties in their retirement accounts as an individual investor. So that was never on the table to change. That's a positive thing, a very positive thing for everybody here. There are other investments in your retirement accounts that could possibly change, but investing, what we do here, buying turnkey rental properties in your retirement accounts, does not seem to be at risk. So that's a very positive thing on that note. One other thing to look into when you talk to your portfolio manager, Eileen, make sure you talk about the possibilities within a solo 401k, because that may be a ticket to avoid UBIT, which is an expense, a tax that potentially could come into play in your retirement account. So make sure you talk to your portfolio manager. Will be able to set you up or at least get you on the right track. And that solo 401k might be the option for you.
GC, I know what UBIT is, but I got a friend that has no idea what that stands for. And just asking for a friend, what does UBIT stand for?
UBIT stands for Unrealized Business Interest Tax, I think.
Okay.
I don't know. Somebody can Google and tell me if I was right there. Basically, when you take out debt in a retirement account, there is a tax that can be associated with that retirement account. It differs greatly between which type of vehicle you have, whether that's an IRA, a solo 401k, 403b. So, again, it's really something that we need to spend some time talking about. That's the value of working with a partner like JWB with portfolio managers who manage over $450 million of rental properties, because we can help guide you and put you in touch with that provider who can maybe potentially help you avoid UBIT while you are taking debt out, while you are getting financing in your retirement accounts.
Lee Bishop, living up to his MVP status, puts in the chat, unrelated business income tax.
I think that's what I said, right? Is that good?
I don't know, because
we're gonna go with Lee's answer.
Yeah, I'm gonna go with Lee. He's got the MVP award. What's EQRP? Asking for a friend.
I don't know what EQRP stands for. I'm not very familiar with EQRP. I've heard it thrown around a lot. I'm not really sure, to be quite honest.
Okay, moving on then. I would love to see it in the chat, right? Wisdom of the community. That's why we build a community. I got a question for you, GC, that put an instant smile on my face the moment I saw it come on the Q&A. Raul Tirado asks, do you have internal data that tracks actual versus estimated cash flows? Oh
my goodness. Raul, you guys, I love our community. It's like you guys are like in the pre-production meeting with Pablo and I, where I'm like, hey man, I got some information here. This is something that I love to talk about, or lists might be coming down the pike. You guys are like in our dome piece, which is awesome. Raul, thank you so much for that question. We love to track estimated returns versus actual returns. And I'm so glad you asked about it, because if you go outside of JWB and any other provider in the country, I have never seen any other provider actually track what they told you your property was going to return versus what actually has transpired. I haven't seen it anywhere else. And JWB has done this for every property we have sold to clients since 2011. It's over 2,200 properties now that are tracked to this level of detail, and it's done every single month. And this is shared with you as a client of JWB with your portfolio manager. We sit down with you once a month and we review this. It's an incredible tool for you to make sure that your money is being managed well. It's an incredible tool for JWB. Frankly, I don't understand how other businesses know what they're doing well and know what they're not doing well in terms of their client experience, because if you're not tracking this, you can't learn. You don't know if your maintenance costs are right in line with the expectations, or your vacancy costs are right in line with the expectations, or how are you estimating property taxes versus what they are, or insurance costs, right? Everybody else just seems to say, oh yeah, we're good. We got that in line. Well, because we actually track this, like, I can have confidence with you here and say, no, I know that we're good. I know that we're good. And it's because we actually track this. So it's called the Client ROI Report. It is free. It is included with you being a JWB client. It's something that we love to share with clients. In fact, for anybody who's not a client yet, this is a part of our onboarding process. We go through a client demo with you and we walk you through exactly what this Client ROI Report looks like. So you'll get to see what it looks like, or what it feels like to be a JWB client. So we got you there, Raul. Excellent question. Thank you so much for your contribution.
Yeah, Raul, I know that you've been here before. There's a term that we throw around on this show that every time it comes up, I can't shut up about it. And it's the Data Flywheel. And that's because I'm a student of business, right? As an entrepreneur, I'm very much into reading about and executing from what other people have learned. And there's an author called Jim Collins that wrote the book Good to Great. He's kind of like the seminal author on business, how to build an enduring business. And in the book Good to Great, he talks about how all these companies that have made the leap from good to great, within their industry, that differentiates themselves, have what is called a data flywheel. And it is how you create a business that allows you to implement data, to like tease out and implement data that gives you an unfair cumulative advantage to everybody else. And it's normally something that you see at like a Fortune 500 level, at like a Amazon.com has an infamous data flywheel, right? Across multiple things, across their products, across their servers, all these different things. It's a very well understood Silicon Valley term. And the reason why it always geeks me out is this idea that these 4 dudes from Jacksonville that run like a real estate company have a data flywheel that actually executes on this the way that Amazon does, the way that Jeff Bezos does, right? So like when I look at like Gregg and his partners and think that they're 37 years old and they've built a $150 million company and they already have all this stuff in place, I wonder what they're going to be when they're 60. It's really, really impressive to me. And it's something I'm trying really hard to implement in my business, and it's really hard. So I think it's cool. Every time you bring it up, I'm going to geek out on it. Bill Oxley writes, Andrew would like to know if your commercials can be seen on YouTube.
We can post them in the Facebook group.
That's what I was thinking. I think we need to have listen, spoiler alert, anybody that hasn't seen that commercial, it's really cheesy. Like, it's like, hey, I'm Gregg and I'm Pablo and we want to buy your house. Like, it's really
I'm a little nervous about posting the group. People are going to think that we're trying to act like we're all big and bad or something. So Bill, if I post this in the group and anybody else posts it in the group, make sure that you comment on it and don't make it seem like I'm trying to be boastful that we have TV commercials or anything like that. All right.
Yeah. We cannot post that in the group without some heavy, obvious self-deprecation.
Yes, exactly. Right. That would be the topic of the post, please.
There's the data flywheel, and then there's the commercials, completely opposite sides of the spectrum. All right. So, okay, cool. GC, we talked about this monthly cash flow, right? This estimated conventional financing, total monthly cash flow, $136, the scalable, typical monthly experience. Talk to me about this estimated conventional financing total ROI so we can go through the 5 pillars.
So we've talked about how important it is to have this scalable and this risk mitigation in place, which is what your monthly cash flow is. As long as that's positive, you've got scalability and you've got risk mitigation. Now we also want to talk about upside, right? How does my upside compare with my other investment alternatives? In the stock market, generally over time, you earn between a 7 to 9% return on investment. But think about where you're earning that return on investment from. That is from stock appreciation, right? Generally, you're not getting dividends. And if you're getting dividends, it's not 7 to 9%, right? That 7 to 9% that you historically earn way over time in the stock market is coming from stock appreciation. Well, compare that to what we're looking at here, right? This total return on investment of 7.27%, this estimated return on investment, has nothing to do with home price appreciation. Remember, in the stock market, it's all about stock appreciation. That's how you get to 7 to 9%. In rental property investing, I'm showing you that you can earn over 7% here, and we haven't even talked about appreciation, which is incredible. So this 7.2% estimated return is looking at really the costs, the profit centers that we can control and the costs that come along with it. So you've got your profit centers, right? One of your profit centers is net rental income. Means like the rental income that's left over after you pay all of your expenses on a monthly basis. Well, then you also have two other profit centers that happen all the time. One of those is principal pay down. What that means is that when you have a loan in place and your resident's paying you rent every single month, a portion of that rent is going to pay down the principal on your loan. So your loan balance is going down over time and you didn't have to pay for it. Your resident's paying for it. So that's another profit center. Also take into account your tax savings. You get tax savings for investing in rental properties that you just don't get in other asset classes. And there aren't qualifiers of you have to earn this much money or be a real estate professional or all this, right? These are additional tax savings that you get just because of the beauty of this asset class. So you take into account those tax savings. You also take into account other costs that are going to happen every once in a while, like maintenance costs, vacancy costs, tenant placement fees. Those things do happen over time. They just don't happen every month. But we include those here as well. And you divide all of that and you divide it by your initial investment plus your closing costs, right? Your down payment plus your closing costs. So you get all of that, and that still kicks out over 7%, which is basically just what the stock market does over the long haul, right? If you're investing in the stock market and you're in for the long haul, you're probably expecting 7 to 9%. Well, boom, you got that here in rental properties. And again, we didn't even have to talk about home price appreciation, right? That is really cool. And by the way, it comes in every single month, which in the stock market, it doesn't, right? You're waiting for the big pop at the end. So that's in essence why I love rental property investing. Now, this is a good segue to talk about real upside, like huge upside here, right? And that can come from a buy and hold strategy of holding for a full market cycle when you get to take into account home price appreciation.
Yeah, you're right, GC. We didn't need to talk about home price appreciation, but I want to talk about home price appreciation. So tell me, why is it 0 and what happens when we take into account home price appreciation?
Great question. It is one that we get often on the show. If Jacksonville is a growth market, which means that you have higher home price appreciation here than you do in other parts of the country, why do you go so low on your expected appreciation rate and put 0 right off the bat? And there's a couple of reasons here. Number one, JWB, one of our core values is under promise and over deliver. And when you're looking at home price appreciation, if this asset can compare to our competition, meaning the stock market, and it suits up and does a better job of that because it's 7 to 9% returns and it's recurring revenue every single month and it's more consistent, then this asset class stands on its own 2 feet. We don't have to show all of the bells and whistles of what this asset class can do in order for it to be something that clients want to invest in. And it gives us the opportunity then to under promise and over deliver, which is how we're built. So that's number one. Number two, if you're going to be counting on home price appreciation, you need to be investing for a full market cycle. And as fans of the show, for those who have been watching for a year or 2 years now, hopefully you subscribe to the way that we think internally here, which is we buy and hold for a full market cycle. But, not everybody invests that way. And so if you buy and hold for a full market cycle, history shows us that home price appreciation tends to repeat itself if you give it enough time, and a market cycle is between 10 to 20 years. That means that you are going to see roughly, in Jacksonville, it's 4.3% appreciation historically is what we've seen on average, right? So for the next 10, 15, 20 years, if you look back, we're probably going to see roughly 4% appreciation when we look back. But the key is you have to be in for a full market cycle. So if you are not, then I don't think you should count on home price appreciation. And that's why I put it at 0 right on the evaluation off the bat. Just don't know if you are going to be in for the full market cycle. And if you are, then I think you should be putting in your home price appreciation rate for your specific market. And Pablo, you have us teed up 4.3% here in Jacksonville.
Yeah. So before I hit enter on this and make the magic happen, I just want to say that, it's 4.3% appreciation over a whole market cycle, which Raul Tirado is asking the length of that. Raul is not an exact definition, but it's 10 to 20 years. So within 10 to 20 years, the market will be cyclical at some point in there. We're seeing that right now in the sense that right before the Great Recession to now, it's almost exactly 4.3%. At the worst investment time to right now, it's almost exactly that. And if you go before that and, whatever, if you take out these long enough segments, you get to it, right? So That's the answer to that. But right now, this last year, it's been 20%, right? Like right now, I think home price appreciation is like 8, right? So like right now, it's like you get in during this like inflated time and you're almost playing with house money on the front end, which I think is a really powerful position to be in, right? So I'm going to go ahead and press enter here because again, this is interactive sheet. It goes from 7.2% ROI, 2.27 ROI to put in 4.3, and it goes to 22.91% ROI when you include that. GC, can you explain that to me?
Absolutely. This is the beauty of leverage. Leverage means that when the value of the asset goes up 4% in that year, your return on investment from that asset growing is not 4% if you use leverage, right? If you put 25% down, which means that you only put a quarter of your money into the deal, and the asset grows 4%, you can take that 4% growth and multiply it times 4. And it would actually be a 16% return on investment from that appreciation. Again, if you're following at home, take out your phone. I don't have my phone here. There we go, right? You want to do some quick math here, right? If you've got 4% of the growth, right? And you divide it by 0.25, it gets you a 16% return on investment. What you're saying there is 4% is what the market grows, but you only put down 25%. That's going to get you a 16% return on your investment just from the home price appreciation. And so if we look here at the evaluation, we can see that it went up from roughly 7% to roughly 23%. Well, now we've included home price appreciation and the beauty of leverage. It's gone up from 7 to 23, which is roughly 16%. And that is the icing on the cake why I love rental property investing.
Yep. And we do it on every one of these POTWs because it was like the biggest aha moment of my life. Like once we started doing this stuff, it went from like educated conversations with my friends about like, man, Gregg says all this stuff, but then they would say, but I can put it in the stock market or I can do this and that. Once you kind of like conceptualize this idea that the stock market is only appreciation and everything else here in this asset class is what you're getting plus appreciation. And B, the idea that there's nowhere in any stock market that you can put in $20 and get $100 worth of stocks, right? That is, that's what makes this asset class really, really special, which made me hurry up and get all my ducks in order and buy a couple of rental income properties, AKA sell my Peloton stock. GC, it's been an hour, man. I don't know what happened. I feel like I just blinked and an hour went through. It's 1:30.
Can we go another hour?
I mean, I would love to, but I got to get back to strategic planning, buddy. But this was awesome. I can't wait for Tuesday when Brian Reyes comes on here and starts talking about like what's coming down the pike, how to react to it, like all these tax things that everybody hears about. And all the research he puts into it. He's like a maven, right? Like if you read The Tipping Point, the maven, the guy that goes out there and really understands everything and is able to explain it. Super, super value add person to have in your network. And because we're part of the Not Your Average Investor Show family, we get to have him in our network and get to pick his brain. I think it's amazing. Can't wait for that call. Like we like to say, if you ever wanted to know about rental income properties, you came to the right spot. If you wanted to know about rental property management for investors, you're in the right spot. If you want to know about the Jacksonville market, we learned a little bit about that too. You're in the right spot. Next place, chatwithjwb.com. Raul, I see you in the chat saying great session. I appreciate you, man. And Anthony also, I appreciate you, man. Listen, thank you for coming, right? Like whether you go to chatwithjwb.com or not, thank you so much for coming. We never take for granted this idea that you spend an hour out of your day in the middle of a work day to just come here, spend an hour with us. That felt like it flew by, but it was a lot of fun for us. And it's really what makes the show special, right? Like any talking head can stand here and just talk about concepts and like teach stuff or do a webinar. But the fact that we get a community that adds to the conversation is really what makes this valuable. So thank you for being here. I love the POTW. GC, welcome back. I freaking missed you, bro. Not gonna lie.
I missed you too. I missed you all.
And I'll give you last call.
Yeah, you guys are super special. And with me not being here last week, I tell you, man, you guys, this has created just a part of my everyday being, like being here with you on the show. It's something that I missed last week. I'm excited to be back in the saddle here today and really excited for the show on Tuesday coming up with Brian. If you enjoyed it, we would love for you to come back. That's the best way for you to tell us that you really enjoy what we're doing. So if you're new to the show, We would love to have you be a part of this community. We hope to see you on Tuesday. And for all of our NYAI veterans on the show, we love you. Thank you so much for everything you do for this community, and for all of our veterans out there, the real veterans out there. Thank you guys so much for your service. All right, everybody. We'll see you next Tuesday.